Usually, when we talk about a medical diagnosis, there is this expectation of precision.
Right.
It's like engineering, You break your arm, the x-ray shows that jagged white line, and the doctor just points and says, well, there it is.
Yeah, exactly. It's very clean.
Right. It's binary, it's clean, broken or not broken.
I mean, it's a comforting illusion, really. We like our problems to be highly visible and just neatly categorized.
We do. But then you step into the world of corporate earnings, and suddenly that x-ray machine is completely broken.
Oh, totally.
You look at a company's quarter, and the diagnostic landscape is just incredibly murky. You have weather impacts, masking core performance, regulatory shifts, rewriting the rules overnight.
Yeah, and strategic pivots that change the entire risk profile of the business.
Exactly. So today, on this Special Talk Tickers edition of The Deep Dive, we are fixing the machine. We're going to clear the mud off a company that is fundamentally rewiring its own DNA right in front of us.
I love that framing.
We are taking the raw audio and the transcript of CMS Energy's Q2 2026 earnings call. That is ticker symbol CMSM. And our mission today is to cut through the corporate jargon to extract the actual actionable mechanics of what is happening here. No fluff, just the numbers, the strategy, and what this means for your portfolio.
I mean, it is the absolute definition of diagnostic muddy waters, but it's also one of the most fascinating case studies in the market right now.
It really is.
Because on the surface, you are dealing with a utility, the traditional sleepy widows and orphans stock that you just buy for the dividend and forget about.
Right, a total sleep at night stock.
Exactly. But underneath that surface, CMS is navigating this massive structural shift.
Right, and that's the friction point I want to start with, because looking at the headline numbers they reported for the first half of 2026, I am seeing an adjusted earnings per share, or EPS, of $1.50.
Yep, $1.50.
Now, on paper, that $1.50 keeps them perfectly on a glide path to hit their full year guidance. But I have to push back on the idea that this was just a clean, easy win.
Okay, let's hear it.
Because anyone who tracks utilities knows they are brutally sensitive to the weather. You sell power when people crank their air conditioners in July, right? Or their heaters in January.
No, absolutely. Weather is everything.
And this summer, in their Michigan service territory, it has been strange. We haven't had those sustained, week-long, blistering heat waves that really force the meters to spin. So, I mean, how much did the sky actually dictate this $1.50 EPS?
Well, the sky was a massive drag, actually, and the management team was very transparent about that on the call.
Okay.
You are hitting on a concept utilities call cooling degree days and heating degree days.
Right.
It is essentially a mathematical measurement of how far the daily temperature deviates from a baseline, which is usually around 65 degrees.
Got it.
And that indicates how much energy people need to use to heat or cool their homes. CMS's CFO, Sri Matapati, noted that mild temperatures compared to normal historical averages created an unfavorable variance of $0.08 per share.
Let's break down that jargon for a second. An unfavorable variance of 8 cents just means they made 8 cents less per share than they historically would have if the weather had been strictly average, right?
That's exactly it.
And while 8 cents sounds like pocket change, when you multiply that across hundreds of millions of outstanding shares, I mean, you are talking about tens of millions of dollars in missing revenue simply because Mother Nature decided to keep it breezy in Michigan.
Precisely. It is a massive chunk of the weather. Wasn't just about a lack of heat. It was actually a dual front war.
Oh, really?
Yeah. Mother Nature also hit them with severe storm activity, particularly a brutal storm right around the 4th of July.
Oh, right. I remember that one.
Yeah, and that created a massive operations and maintenance, or O&M drag, of 19 cents per share.
Wait, hold on. Let's unpack the mechanics of that O&M drag. 19 cents is a huge hit.
It is.
Why does a storm hit the operations and maintenance line so violently? I mean, shouldn't fixing the grid just be a standard capital expense?
So this is where utility accounting gets fascinating, and it's vital for understanding the balance sheet.
Okay, lay it on me.
When a utility builds a brand new substation, that is a capital expense. They earn a long-term return on it.
Makes sense.
But when a severe storm rolls through and rips down existing power lines and transformers, the immediate emergency response, mobilizing armies of linemen, paying emergency overtime, clearing down trees, bringing in out-of-state contractor crews.
Right, is that chaos?
Exactly. That does not create a new asset. It just restores the old one. Therefore, accounting rules dictate that those immediate repair costs flow directly into operations and maintenance expenses. losses.
Oh, wow. So it hits the income statement immediately.
Immediately. So if you take the $1.27 loss to mild weather and combine it with the $1.19 loss to storm cleanup, CMS was facing $1.27 per share hole in their earnings right out of the gate compared to a normal quarter.
Okay, so this is where the math gets really interesting to me. If they are down 27 cents from a combination of mild weather and destructive storms, how on earth did they still manage to report a solid $1.50 EPS and keep their full year guidance intact?
Right, it seems like magic.
Because you can't just invent 27 cents per share to plug that hole. Where did capital come from?
It came from the regulatory engine. The saving grace for CMS this quarter, the mechanism that actually plugged that massive hole, was the implementation of new electric and gas rates.
Oh.
Those new rates netted a positive $0.20 per share.
Okay, let me play devil's advocate here, because if I'm a ratepayer in Michigan listening to this, it sounds like the utility had a bad summer, lost money on storms, and just decided to hike my monthly bill to cover their losses. I mean, is that how this works?
It is a really common misconception, but no, the timing is actually a complete coincidence.
A coincidence.
Yeah. Utilities cannot just hike prices reactively because they had a bad quarter. They have to go through this rigorous, highly adversarial legal process called a rate case.
Right.
They go before the state's Public Service Commission, and they have to explicitly prove with literally thousands of pages of documentation that they have invested capital into the grid. Upgrading pipes, modernizing substations, integrating renewables.
It's a huge bureaucratic hurdle.
Exactly. And if, and only if, the state agrees those investments were prudent and benefit the consumer, the utility is allowed to raise prices to earn a regulated return on that specific investment.
So what we are seeing in this $1.20 per share boost is really the delayed financial reward for infrastructure work they did in the past.
Exactly. The CFO pointed out that they are finally seeing the benefits of a gas rate order from last year, newer electric rates that just commenced in May of this year, and continued investments in renewable projects that are strictly within the regulated utility.
Okay, I see.
That 20-cent boost acted as a financial shock absorber. It effectively insulated their bottom line from the absolute worst of the weather and storm headwinds. It proves to Wall Street that their core regulatory relationship in Michigan is highly functional.
So the takeaway on the headline numbers is that you have a company highly exposed to unpredictable, volatile weather, but they have engineered a regulatory safety net that catches them when they fall.
Spot on. That is the baseline utility thesis.
But let's pull the lens back, because while navigating a stormy quarter is great, it doesn't change a company's overall trajectory. If we look at what actually drove the narrative on this call, the biggest bombshell didn't come from the sky.
No, it didn't.
And it didn't come from the regulators. It came from the boardroom. CMS announced they are completely restructuring a segment of their business called North Star, and they are fully exiting the non-utility renewables development business.
This was the defining strategic move of the quarter. And frankly, it fundamentally rewires the risk profile of the entire company.
Now, I want to challenge this move because on the surface, reading that a major energy company is creating the renewable development business in 2026 feels just, well, counterintuitive.
I get that.
Clean energy is the biggest mega trend on the planet. Trillions of dollars are flowing into it. Why would CMS step away from the table right now?
To understand why they are exiting, you have to understand the difference between the regulated utility business we just discussed and the merchant or non-utility development business.
Okay.
When CMS builds a solar farm in Michigan for their regulated utility, they are guaranteed a return by the state. It is incredibly safe.
Right, because of the rate cases.
Exactly. But the North Star segment was doing something entirely different. They were operating as a merchant developer. They were going into other states, places like Ohio or Texas, and trying to develop, build, and operate wind and solar projects in highly competitive, unregulated markets.
So it's essentially a side hustle. If their main Michigan utility business is like a secure 9-to-5 job where you know exactly what your paycheck will be every 2 weeks, the North Star development business is like coming home and day trading commodities.
That's a great analogy.
Sometimes you make a fortune, sometimes you lose your shirt, but it requires constant attention, massive amounts of upfront capital, and it exposes you to volatile market pricing.
That is a highly accurate way to frame it. And the macro environment for that specific side hustle has become incredibly toxic over the last few years.
How so?
Well, You have high interest rates making borrowing extremely expensive. You have severe supply chain bottlenecks for solar panels and transformers. You have interconnection queues, meaning you can build a wind farm but have to wait years to actually plug it into the regional grid.
Wow, that sounds awful.
It operates like a leaky bucket. No matter how much capital CMS poured into Northstar, market volatility and logistical delays kept poking new holes in the financial models. Management looked at this and realized the risk-to-reward ratio had completely inverted.
Okay, so let's look at the financial mechanics of quitting the day trading side hustle, because the numbers they presented on the call regarding this exit were staggering.
They really were.
By abandoning these out-of-state, non-utility renewable projects, CMS avoids $1.7 billion in planned capital expenditures over their current 5-year plan. $1.7 billion.
Which is capital they now do not have to borrow at high interest rates, and more importantly, it is capital they do not have to raise by diluting their own shareholders.
Let's break down that dilution mechanism, because I think a lot of retail investors see capital expenditures and just think of it as a corporate problem, not a shareholder problem.
Right, it feels abstract.
Matapati, the CFO, explained that to fund their previous growth plans, they were going to have to issue $3.75 billion of new equity over the next 5 years. How does cutting this $1.7 billion Northstar budget change that math for the person holding the stock today?
Well, issuing equity literally means the company is creating new shares of stock out of thin air and selling them to the public to raise cash.
Right.
It is a necessary mechanism to fund massive infrastructure projects, but it dilutes the ownership stake of everyone who already holds the stock. If a company's profits stay the same, but suddenly there are 10% more shares in existence, your individual shares are suddenly worth less.
It is a silent tax on the investor.
Exactly. By abruptly cutting the $1.7 billion in capital spending at Northstar, CMS dramatically lowers their need for cash. They stated on the call that they anticipate reducing their parent funding needs by over $500 million through 2030, and specifically, they will reduce their planned equity issuances by at least $350 million.
So by canceling this massive risky spending program, they don't have to sell as many new shares. The shares that you and I currently hold retain their value because the pool isn't being flooded with new stock.
Bingo.
It makes the financing of the entire corporate structure vastly more efficient. But I noticed in the transcript, they aren't just having a fire sale. They aren't liquidating the entire Northstar portfolio. They are being highly surgical.
Very much so.
They specifically noted they are keeping the Dearborn Industrial Generation plant, which they call DIG, along with a handful of commercial solar and gas peaker plants in Michigan. If you are exiting the business, why keep those specific assets?
Because those specific assets don't require the massive upfront capital investment that new development does, and they already generate robust, highly predictable cash flow.
Ah, okay.
You mentioned the peaker plants. Let's define that. A peaker plant is a power plant, usually running on natural gas, that only turns on when demand for electricity is at its absolute highest, the peak.
Okay, so think of a 100-degree day in August when every air conditioner in the state is running.
Exactly. The grid gets stressed, and these peaker plants fire up to provide immediate, crucial supply. Because they provide emergency reliability, they command a premium price for their power.
So when the CEO said DIG is a core asset from a capacity and energy perspective, he means it provides both the raw electricity when needed, but also acts as an insurance policy for the grid's total capacity limits, which is highly lucrative.
Exactly. They have these assets locked into long-term contracts. So the strategy is brilliant in its simplicity. You keep the existing cash cows that require very little maintenance capital, and you slaughter the capital-intensive high-risk development arm.
Wow.
And the structural result of all of this is what Wall Street really cares about. Post-2027, management expects nearly 100% of CMS Energy's earnings to come strictly from the safe, regulated utility side of the business.
100% regulated.
Yep.
As CEO Garrick Rochelle put it on the call, that is high-quality earnings. It's high-quality growth. That's what our investors expect. And there is a specific financial term for why this matters, right? The valuation multiple.
That's the one.
If I am an analyst modeling this stock, why do I value $1 of earnings from a boring regulated utility higher than $1's earnings from a fast-growing but volatile renewable development business?
It comes down to the certainty of cash flows. The stock market hates uncertainty more than anything else.
Makes sense.
If you have a business unit that might make $100 million one year and lose $50 million the next because of supply chain issues in Texas, investors will penalize the entire stock. They will assign it a lower valuation multiple, meaning they will pay a lower price for every dollar of earnings.
Okay.
By stripping away that complex, volatile layer, CMS makes its future cash flows incredibly predictable. Historically, when a utility simplifies its story and becomes a pure play regulated entity, the market rewards them by expanding that multiple. Investors are willing to pay a premium for a stock when they don't have to lose sleep over unpredictable development risks.
Is the ultimate example of addition by subtraction. But here's where the narrative shifts again. You can de-risk a business all day long. You can optimize the balance sheet and protect your downside. But a safe, heavily fortified business isn't necessarily a growing business.
That's true.
To get real growth, to drive that valuation multiple higher, you need new, massive demand for your product. And in the utility sector right now, demand means one thing. It brings us to the absolute hottest topic in global investing, the catalyst driving trillions of dollars in market cap. Artificial intelligence and data centers.
Oh yeah, the big one.
Every company claims they are an AI play. Is CMS actually cashing in on this, or are we just throwing buzzwords into an earnings call to get the algorithms to buy the stock?
They are absolutely cashing in, but what makes this fascinating is how they are doing it. They aren't just blindly plugging these massive facilities into the grid. They have engineered a structural framework that is borderline brilliant.
Okay, tell me more.
The CEO confirmed major progress on the data center front during the call. They officially reached an agreement under a newly approved framework called the Large Load Tariff, which includes both a specialized rate agreement and something called an Extraordinary Facilities Agreement.
I want to stop right there and dig into the mechanics of this.
Yeah.
Because large load tariff and extraordinary facilities agreement sound like bureaucratic sleep aids, but they actually represent a massive shift in how American infrastructure is funded. What does this actually look like on the ground?
To grasp the magnitude of this, you have to understand the physics and the economics of an AI data center. These are not just warehouses with some servers. We are talking about facilities that require an astronomical amount of electricity.
Like how much?
Often, a single campus will require the equivalent power of a small to medium-sized city, and they run 24 hours a day, 7 days a week. They require massive baseload generation and immense amounts of power just to run the liquid cooling systems that keep the servers from melting down.
Oh, just for the cooling.
Yep. Historically, if a massive new industrial facility came into a utilities territory, the utility would be thrilled, but they would have to spend a fortune building a brand new power plant, upgrading high voltage transmission lines, and building new substations just to serve that one customer.
And under traditional utility rules, the cost of building that new power plant and those new lines would be socialized. The utility would take that massive capital expense, dump it into their overall rate base, and spread the cost out among every single customer in the state.
Exactly.
Which means my monthly electric bill goes up just so some tech giant can train their large language model.
Which is exactly why we are seeing massive regulatory pushback across the country. Everyday voters get furious when their bills spike to subsidize a trillion-dollar tech company. The regulators step in and block the development. It's a massive bottleneck for the AI industry.
Right.
So CMS went to the regulators and created this large load tariff to legally bypass that exact problem. Under this new construct, the new large load customer, the tech company building the data center, must bear absolutely all of the specific infrastructure costs required to serve them.
That's the Extraordinary Facilities Agreement.
Yes. It is a legally binding document that says if CMS has to build a new $50 million substation or upgrade 10 miles of transmission lines specifically to handle your server farm, you are paying for it in full. We are not passing a single cent of that specific capital cost onto our residential customers.
That is massive.
Yeah.
It shifts the entire burden of infrastructure development off the public and onto the corporations that actually need it. But here is the data point from the earnings call that truly stopped me in my tracks.
Yeah.
It wasn't just that they were protecting the residential customer from price hikes. The CEO explicitly stated that for every 1 gigawatt of new data center load they bring onto the grid, the average residential customer in Michigan will actually see their monthly bill drop by roughly $7.50.
It's an incredible stat.
I need you to explain the underlying logic here. If a tech giant builds a massive data center and consumes an ocean of electricity, how does my personal electric bill go down?
It comes down to the mechanics of fixed costs. Think about how a utility operates. They have massive systemic fixed costs that exist regardless of how much power is actually flowing through the lines. The cost of maintaining the corporate headquarters, the baseline maintenance of the legacy power plants, the administrative overhead, the billing system.
Like the stuff you have to pay for just to keep the lights on.
Exactly. Currently, that massive pie of fixed costs is sliced up and divided among the existing households and small businesses in Michigan. You pay a portion of that fixed cost every month in your baseline rate. Now, imagine a data center comes in and demands 1 gigawatt of power.
Okay.
1 gigawatt is a truly staggering, almost incomprehensible amount of electricity.
It's roughly the capacity of a full-scale nuclear reactor, just dedicated to one customer.
Exactly. So this data center becomes a massive new payer into the overall system. Because they have already paid for their own specific infrastructure upgrades through that extraordinary facilities agreement, the massive monthly electric bill they pay for the actual power they consume goes directly toward paying down the systemic fixed costs of the entire utility network.
Oh, I see.
You're taking the exact same pie of fixed costs, and you are now slicing it into many, many more pieces because the total consumption base of the utility has exploded overnight. Therefore, the cost per slice, which dictates the baseline rate for the average homeowner, mechanically goes down. The data center is subsidizing the legacy grid.
This is a masterclass in game theory and regulatory capture. CMS has figured out how to turn the global AI energy crisis into a direct, tangible financial benefit for the average voter in Michigan.
It really is brilliant.
Think about the political cover this provides. If a tech company tries to build a data center in a normal town, the residents protest the strain on the grid. But if CMS walks into a town hall and says, we are going to build this data center, it's going to create jobs, the tech company is paying for their own power lines, and oh, by the way, every resident in this room is going to see their monthly electric bill drop by almost $10.
Suddenly, the local resistance completely vanishes.
Exactly. You align the incentives of the tech giant, the utility, and the local voter.
It completely flips the adversarial narrative of industrial expansion. And we're already seeing the proof of concept. The CEO noted on the call that year to date, they've already contracted roughly 135 megawatts of manufacturing and industrial load.
Wow, 135 megawatts already.
Yeah, and this isn't just AI. It's advanced manufacturing, battery plants, things like that, showing that the Michigan economy is aggressively demanding this power. But the data center piece is the whale. Now, we do have to look at the risks because the analysts on the call were definitely probing the management team on the actual execution of this.
What were they worried about?
Shar Parisa, an analyst from Wells Fargo, specifically honed in on zoning risks. He noted that Microsoft has recently struggled with local zoning board approvals in some specific Michigan sites.
Right, because a town might like the cheaper electric bill, but they still might not want a massive humming warehouse in their backyard. How does CMS navigate that if the tech company can't secure the land?
And that is exactly where the brilliance of structuring this as a broad tariff comes into play, rather than just a one-off bespoke contract. The management team heavily emphasized this nuance. The large load tariff is a regulatory framework. It is not tied to a single plot of land or a single specific tech company.
Oh, interesting.
If a specific data center customer fails to get local zoning approval in Town A, they can simply move their proposed project to Town B or Town C anywhere within the CMS service territory, and that highly favorable contract structure moves right along with them. Furthermore, CMS noted they are actively in deep discussions with multiple different hyperscaler customers across multiple different potential locations. They have a diversified pipeline of demand.
The demand is an unstoppable force at this point. AI has an insatiable appetite for power. The major tech companies are in an arms race. They must build these data centers to train their next generation models, and they will physically deploy capital wherever a utility has the regulatory framework to actually plug them in without years of legal battles.
Exactly.
CMS is essentially waving a giant flag to Silicon Valley saying, we have the regulatory framework, we have the power, and our structure guarantees it won't upset our local ratepayers. Come build here.
And we're going to see exactly how massive this structural load growth really is very soon. On the call, CMS announced a very deliberate procedural delay. They are pushing the filing of their Integrated Resource Plan, or IRP, back to September.
Let's unpack the IRP, because that is a massive catalyst for anyone trading utility stocks. An integrated resource plan is basically the utility's master blueprint for the next 10 to 15 years. Correct.
Yes.
It's the document where they go to the state and say, based on our economic models, here's exactly how much power demand we expect in the next decade, and here's exactly what we plan to build, how much solar, how much wind, how many gas plants, how many battery storage facilities to meet that demand.
That is exactly what it is. It is the roadmap for their future rate base.
Oh.
And they deliberately delayed filing it until September for one highly specific reason. They needed the extra time to structurally incorporate this massive, unprecedented wave of data center load growth into the long-term mathematical models.
Oh.
When that IRP document drops in September, it is going to be heavily scrutinized by Wall Street analysts. It will lay out the precise blueprint for billions of dollars in future capital investments that CMS will earn a guaranteed, regulated return on over the next decade. It will quantify exactly how big the AI boom will be for their balance sheet.
So let's synthesize where we are in the narrative. If you strip away the noise of the quarter, you have a company that just aggressively chopped off its risky, capital-intensive renewable development arm, protecting their shareholders from massive equity dilution.
Right.
Simultaneously, they have legally and structurally isolated themselves from the infrastructure costs of AI data centers, while positioning themselves to reap the systemic rewards of that massive load growth. This naturally leads us into the final piece of the puzzle, how management views their own financial future. When you have this much structural clarity, how does it translate to the bottom line? Did management just reiterate their promises, or did they move the goalposts?
They didn't just reiterate their promises, they executed a maneuver that is basically a flex on the entire market. First, they very confidently reaffirmed their full-year 2026 guidance of $3.83 to $3.90 per share. But they didn't stop at merely reaffirming it. They explicitly guided the market to expect them to hit the high end of that range.
As an investor, whenever a CEO or a CFO explicitly guides to the high end of an earnings range during a Q2 call right in the middle of the year, it tells you something vital about their internal metrics.
Absolutely.
They have immense, almost locked-in confidence in their cash flows for the back half of the year. They aren't leaving themselves any wiggle room for error. They know the money is already in the pipeline.
It is a statement of absolute operational control. But the real showstopper, the moment on the call that made analysts sit up, was what they did regarding the following year. Management introduced their full-year 2027 EPS guidance early. They set it at $4.08 to $4.17 per share.
I want to translate the mechanics of this Wall Street maneuver for the listener, because giving guidance a full 18 months in advance is incredibly rare.
It really is.
Standard corporate practice is to wait until the Q4 earnings call, which usually happens in January or February of the following year, to lay out the financial roadmap for those next 12 months. Giving 2027 guidance in the middle of the summer of 2026 is management's way of standing on the table and shouting. It signals to the market that they have extreme, unshakable visibility into their future cash flows.
It is a profound statement of confidence, and it ties directly back into our earlier discussion about de-risking. When an analyst asked them about the logic behind this early guidance, Sri Matapati, the CFO, didn't hesitate. He flat out said, "We're not biasing the range. We provided confidence in that range. It's really driven by the utility growth." As you think about 2027, we've already incorporated the repositioning of North Star into that guidance.
Let me make sure I understand the causality there. By repositioning North Star, by completely abandoning that $1.7 billion in planned capital spending for the out-of-state renewable projects, they have essentially removed the largest variable from their spreadsheet.
Precisely.
They don't have to guess what interest rates will be for that debt. They don't have to guess what solar panels will cost in Texas in 2027. And they don't have to factor in massive equity dilution.
Exactly.
So they can look at Wall Street and say, we chopped off the risky arm of the business. And precisely because we did that, we can tell you exactly how much money our regulated core is going to generate a year and a half from now. And it is more than you modeled for.
You nailed the mechanism. The early guidance is the direct mathematical result of the de-risking strategy. And to add a cherry on top, they also firmly reaffirmed their commitment to the high end of their 6% to 8% long-term EPS growth rate.
Wow.
If you are an institutional investor, this is the holy grail of utility investing. A completely de-risked, pure play regulated business model that is generating high single-digit, highly visible, and highly predictable earnings growth, all without needing to endlessly dilute the stock.
And what's fascinating here is that even with all that locked-in growth, they casually hinted at massive unmodeled upside that isn't even in the current projection.
Oh yeah, that was a huge moment.
During the Q&A, Sri Matapati brought up their existing $24 billion utility capital plan. But then he casually dropped the fact that there's an additional $2 billion opportunity for utility-owned renewables and another $1 billion opportunity for electric distribution reliability upgrades that are not currently factored into that 5-year financial plan.
Yes, an analyst from Wolf Research immediately caught that and asked for clarification on that $3 billion in upside. The CFO confirmed it. It represents massive future rate-based growth potential.
That's huge.
It is. And here is where the entire narrative connects full circle. Because CMS saved so much capital and avoided so much equity dilution by cutting the North Star development business, they now possess the pristine balance sheet flexibility required to finance those future multi-billion-dollar utility projects internally without constantly going back to the open market to issue massive amounts of new equity.
That makes perfect sense.
It creates a compounding loop of financial efficiency. They cut the risk, save the cash, and deploy that cash into guaranteed regulated growth.
All right. We've covered a massive amount of ground on this deep dive. We have unpacked the underlying mechanisms of the headline numbers, analyzed the strategic exit from the volatile merchant renewables business, explored the brilliant game theory behind the AI data center tariffs, and translated the extreme confidence of their forward guidance.
We really went through it all.
It is time for the bottom line. We have to distill all of this corporate strategy down to the actionable takeaway for the retail investor listening to this right now. Based on everything we just discussed, I need your firm stance. Is this Q2 2026 earnings call a bullish or a bearish signal for CMS Energy stock?
If you look at the mechanics of what management actually executed this quarter, it is an unequivocally bullish signal.
Okay, lay it out for us.
What we witnessed on this call was a masterclass in structural corporate de-risking. They looked objectively at their portfolio, identified the specific segment that was capital intensive, highly volatile, and dragging down their valuation multiple, which is the North Star development arm, and they ruthlessly cut it loose. They took the massive amount of capital they saved and used it to fortify their balance sheet, dramatically reducing their need to dilute their existing shareholders.
They plugged the leaky bucket.
Exactly.
Okay.
And simultaneously, they proved that they have solved the single biggest existential problem facing the utility sector today: how to absorb massive, unprecedented AI data center load without triggering a ratepayer revolt.
Right.
By proving to the market that they can legally and profitably absorb that massive demand while actually utilizing the fixed cost mechanics to lower monthly bills for their everyday residential consumers, they have created a highly defensive, politically insulated, predictable growth engine. They have nearly 100% regulated earnings visibility, a locked-in 6% to 8% long-term growth rate, and a tariff structure that perfectly positions them to be a primary beneficiary of the AI infrastructure boom. The fundamental narrative is profoundly strong.
So, to summarize the action for you, the listener, if you are currently holding this stock, or if you're considering adding it to your portfolio, you need to understand that CMS is aggressively and successfully positioning itself as the ultimate sleep-at-night utility. You get the safety, the dividend, and the regulated moat of a traditional boring utility, but because of their tariff engineering, you also get the asymmetric upside of the global data center expansion, all wrapped in a much cleaner, significantly less risky balance sheet.
It is incredibly rare to see a management team execute a strategic pivot this cleanly while simultaneously addressing a macroeconomic trend as massive as AI power demand. They are pulling all the right levers.
Which brings me to a final provocative closing thought. Something for you to mull over as you look at your broader portfolio, well beyond just CMS Energy. We just spent this entire deep dive unpacking how CMS has seemingly cracked the code on making massive tech companies pay their absolute fair share for infrastructure, resulting in a projected $7.50 monthly discount for regular households for every gigawatt of new load. It is a brilliant piece of regulatory engineering. But here is the critical question you need to ask yourself as an investor in the broader energy space. If this Michigan model tariff proves successful, if CMS actually builds these massive data centers and the residential voters actually see their electric bills go down, how long will it take before consumer advocates, politicians, and regulatory commissions across the rest of the country look at Michigan and say, we want exactly that?
Oh, it's inevitable.
Will regulators nationwide begin to force every other utility to adopt this exact same blueprint to protect consumers from the AI energy crunch? Because if this localized framework becomes the mandated national standard, Any utility out there that is currently relying on socializing the massive costs of data center infrastructure across their residential base is going to face a brutal regulatory reckoning.
Absolutely.
CMS just showed the world that AI expansion can be done without punishing the voter. The question is, who will be forced to follow their lead, and which utility stocks will get crushed if they refuse?
That is the multi-billion-dollar question that will define the utility sector for the next decade.
And that is exactly why we do these deep dives, to find the structural shifts and the underlying mechanics before the rest of the market catches on.